During the COVID-19 outbreak, Indonesian government, as any other developing economies, implement some counter-cyclical policy, which are the combination between fiscal and monetary regulation to ease the effect of pandemic. Acted as the Microprudential Supervisory Board, the Indonesian Financial Service Authority imposed a credit restructuring policy for the banking sector to stabilize the nation's financial system and boost the economic growth. My name is Veronica Swasti Paramitha Putri, and this is my research with the title The Impact of Credit Restructuring Policy No. 11 POJK.03 2020 Towards the Indonesian Bank's Financial Performances. The COVID-19 pandemic has caused so many socio-economic problems, such as the increase of poverty and the decline of life quality. Moreover, the Indonesian government's regulation regarding the society's restricted mobilization program during the pandemic has led to an economic contraction up to minus 2.2% in 2020. The declining ability for the debtors to repay their loans and the reluctance of banks to extend credit to the public due to high credit risk potentially cause a phenomenon known as credit crunch. The increase in credit risk will further disrupt financial system stability and slow down economic growth, and therefore must be mitigated and solved immediately through policy intervention. Therefore, the Indonesian Financial Service Authority, or OJK, issued Policy No. 11 POJK.03 2020 concerning Indonesian economic countercyclical stimulus through credit restructuring policy that has two main objectives, which are to provide some time and opportunity for the banking sectors to improve and restructure their corporate cash flow and give debtors some chances to reorganize their business, thus enables them to meet their credit obligations. However, acted as a relaxation policy during a crisis, the further impact of the credit restructuring policy is something that needs to be observed because it can further increase the composition of non-performing loans and loan at risk after it is imposed. When financial regulations are enforced, the economy will be expected to move accordingly. Therefore, this study is aimed to examine the impact of OJK Regulation No. 11 POJK.03 2020 on the financial services and the performance of the banking sector in Indonesia, both through fundamental and market analysis. The fundamental analysis will be capture banks' credit quality, credit allocation, liquidity, and profitability using the published quarterly financial reports data, and the market analysis will be examined through the calculation of Tobin's Q. Before we go any further with this research, I will give you a brief introduction about the main subject of the study, which is the Indonesian Financial Service Authority's Policy No. 11/POJK.03 2020. This policy is a counter-cyclical policy in the banking sector that strives to improve the banking performance by maximizing the bank's intermediary function, maintaining financial system stability, and promoting economic growth. At first, this policy was issued on March 2020 and planned to be valid for 1 year as a quick response to ease the impact of COVID-19 outbreak in the economy. However, since the economic conditions were still struggling during the first quarter of 2021, the Indonesian Financial Service Authority, or so-called Otoritas Jasa Keuangan, decided to extend the policy implementation until the end of March 2022. This policy mainly consists of 4 types of intervention, namely liquidity supports, prudential policy, borrower assistance, and monetary policy. We developed the study into 11 hypotheses according to 11 dependent variables as the proxies of financial performances indicator. In short, based on some theories and previous studies, we aim to prove that the policy No. 11 POJK.03 2020 will improve the overall financial performances of banking industry, whereby it will increase the bank's capital adequacy ratio, it will increase the bank's gross non-performing loan, it will decrease the bank's net non-performing loans, it will decrease bank's credit impairment losses, it will decrease bank's loan-to-deposit ratio, it will decrease bank's primary statutory reserve requirements. It will increase bank's liquidity coverage ratio. It will increase bank's net stable funding ratio. It will increase bank's return to asset. It will increase bank's return on equity. And it will increase bank's market performance that will be reflected through the increase in Tobin's Q value. Until June 2022, there are 107 banks listed on the Indonesian Financial Service Authority. Out of those banks, 46 companies are registered in the Indonesian Stock Exchange. However, 5 out of them are not actively traded through the observation period from the first quarter of 2018 until the second quarter of 2022. Therefore, based on this consideration, this research will only use 41 banks to examine banks' market performance and apply 46 banks to examine banks' fundamental performances. This research applies a quantitative quasi-experimental research whereby it examines the impact of policy intervention without sample randomization. Using a purposive sampling method, this study incorporates secondary data obtained from the Indonesian Financial Service Authority's website, Definitive Icon, and Osiris Financial Database. There are some data analysis methods conducted in the study, which are the descriptive analysis, the classical assumption test, which proved that the data are not normally distributed, but there is no multicollinearity, heteroscedasticity, and autocorrelation problem in all research models. And as for estimation models, all of the research model will use random effect models because the Chow test shows that the chi-square probability value of 0.00, while the Houseman test shows that the chi-square probability value of higher than 0.05. The test for equality is conducted for both parametric and non-parametric data. And finally, the linear regression model is conducted to test the research hypothesis. The following slides are the definitions and formulas of some operational variables applied in the study, namely the capital adequacy ratio that evaluates banks' solvency management, the gross non-performing loans that measures banks' creditworthiness, the net non-performing loan that has the same purpose as the gross non-performing loans but only consider loss collectability criteria into the calculation, the credit impairment losses that acted as a signal for a bank's health, the loan-to-deposit ratio that assesses bank's liquidity through its capability to fund its debtors with its own capital and third-party funds, the statutory reserve requirement, which are defined as the minimum amount of funds that must be maintained and controlled by the bank, the liquidity coverage ratio and net stable funding ratio that both are controlled and in accordance to the Basel III regulation, the return on asset and also return on equity measuring banks' profitability, and the Tobin skew as a proxy to measure the bank's market performances. The independent variable is the credit restructuring policy number 11 POJK.03 2020 to measure its impact towards the previously mentioned dependent variables. And as for the control variables, this study applies net interest margin, bank size, and also bank's ownership into the research model. The ownership of the bank is determined using dummy variable, whereby 1 indicates that the bank is owned by the state government and 0 is otherwise. These are the first, second, third, and fourth research model. These are the fifth, sixth, seventh, and eighth research model. And finally, these are the 9th, 10th, and 11th research model. This is the descriptive statistic result of all variables in the model. Aside from regression analysis, this study also examines the mean comparison between variables before and after the policy is imposed. Using the paired sample t-test, the table shows that the variables that experience an increase after the policy is imposed were capital adequacy ratio, liquidity coverage ratio, net stable funding ratio, return on asset, return on equity, and also Tobin skew. Meanwhile, the variables that experience a decrease in mean after the policy is imposed were gross and net non-performing loans, credit impairment losses, loan-to-deposit ratio, statutory reserve requirement. However, to use the paired sample t-test, the data must have a normal distribution because the study are not normally distributed. A non-parametric differential test is needed. Using the Wilcoxon sign rank test, this table shows that all variables move to the same direction as what previously mentioned in the paired sample t-test results. Therefore, we may conclude that there are differences among variables before and after the policy is imposed. From the regression analysis of all research models, we examined that the independent variable is significant, influencing the dependent variables at level of 1%, indicating a rejection of null hypothesis in all research models. For the first research model, we may conclude that after the policy is imposed, the bank's capital adequacy ratio will be increased by 5.1%, indicating better financial performance in terms of credit quality. This table also shows that after the policy is imposed, the bank's gross non-performing loans will be decreased by 0.31%, indicating better financial performance in terms of credit quality. This table shows that after the policy is imposed, the bank's net non-performing loans will be decreased by 0.27%, indicating better financial performances in terms of credit quality. This table shows that after the policy is imposed, the bank's credit impairment losses will be decreased by 0.75%, indicating better financial performance in terms of credit quality. This table shows that after the policy is imposed, the bank's loan-to-deposit ratio will be decreased by 4.91%, indicating better financial performance in terms of credit allocation. This table shows that after the policy is imposed, the bank's statutory reserve requirement will be decreased by 2.33%, indicating better financial performance in terms of liquidity. This table shows that after the policy is imposed, bank's liquidity coverage ratio will be increased by around 64%, indicating better financial performance in terms of liquidity. This table shows that after the policy is imposed, the bank's net stable funding ratio will be increased by around 54%, indicating better financial performance in terms of liquidity. This table shows that after the policy is imposed, the bank's return on asset will be increased by 0.6%, indicating better financial performance in terms of bank's profitability. This table shows that after the policy is imposed, the bank's return on equity will be decreased by 2.76%, indicating better financial performance in terms of bank's profitability. This table shows that after the policy is imposed, the bank's Tobin skew will be increased by 0.02%, indicating better financial performance in terms of market analysis. And after examining the effect of Regulation number 11 POJK.03 2020, it can be concluded that the Indonesian Financial Service Authority's regulation have positive impacts towards the bank's financial performances. It is shown by the increase in credit quality, which is demonstrated by the increase in capital adequacy ratio and the decrease of gross and net non-performing loan, as well as credit impairment losses. The increase in credit allocation, which is observed by the decrease in loan-to-deposit ratio, the increase in bank's liquidity, which can be examined through the decrease in statutory reserve requirements, and the increase in both liquidity coverage ratio and net stable funding ratio. The increase in bank's profitability, which can be elaborated through the increase in return on assets and return on equity. And finally, the increase in market performances, which can be shown by the increase in Tobin skew. However, this study has several limitations. The first one is due to limited sample and observation period. The study findings cannot be applied to any other scenarios. Second one is this study only examines the impact of counter-cyclical policy on the cases of Indonesia, so it cannot be concluded for any other countries. And lastly, this study only examines the impact of counter-cyclical policy as a whole without grouping them by the type of intervention. Therefore, for further research, it would be better if we apply a longer observation period and use research sample from other sectors in the economy. We observe the counter-cyclical policy in other countries that will be captured better the effectiveness of policy intervention during the time of crisis, because the reaction might be different between developing and developed countries. And finally, policy categorization, as what's done in study of Demircik 2021, can be better capture the effectiveness of financial policies based on their specific treatment and purposes. Despite having some limitations, this research has proved that the Indonesian Financial Service Authority's Credit Restructuring Policy number 11, POJK.03 2020 is effective to boost the financial performances, both fundamental and market performance of Indonesian banks. Therefore, acted as a counter-cyclical policy, this regulation can be considered as an effective instrument to stabilize nation's financial system, as well as an economic growth driver during the COVID-19 pandemic crisis. My name is Veronica Swasti Paramitha Putri. Thank you very much for your attention.